in late '08, the loss of some of the most important banks and investment banks, and people started talking about the end of the world. Security prices melted down, loan prices melted down, and activity froze because everybody was uncertain. Will there be a tomorrow? If I buy anything today, will there be a market tomorrow? Will it have any value tomorrow? And all liquidity dried up. And as I say, people were talking about the end of the world, and it was the most pronounced cycle that we've lived through. But still, there was really no reason. I mean, I kept thinking about what Roosevelt said: the only thing we have to fear is fear itself. People were just afraid. They weren't afraid of anything rational. They were just afraid. What you had to do is you had to keep your wits. You know, one of the hopes is that if you read history, if you read the book, if you understand cycles, you will be able to reduce the emotional influences at that time and cut through them, and maybe we'll just say keep your wits about you. So we concluded in late '08, after the bankruptcy of Lehman Brothers put the markets into free fall, that will the financial world end or not? What we said was that it's hard to predict the end of the financial world. If you conclude that the financial world will end, it's hard to have any idea what to do, and most of the time the financial world doesn't end. We also made a very simple calculation. Should we buy or not? Well, if we invest and the financial world ends, kind of doesn't matter. But if we don't invest and the financial world doesn't end, then we didn't do our job. Here we are in an environment where really people had no idea what was coming next, and we're talking about the end of the world. And I thought the analysis was rather simple, that we had to buy. So at Oaktree, we invested $650 million a week in the last 15 weeks of '08. That's about $10 billion. That's really all you had to do. It almost didn't matter what you did as long as you bought. And it was a point in time in the cycle, and these points in time come along every once in a while, where you don't need conservatism, caution, risk control, discipline, patience, or selectivity. You need money and the nerve to spend it. If you had money and nerve to spend it in late '08 in the credit market or early '09 in the stock market, you've made a ton of money by playing that cycle.
You know, there's only one intelligent form of investing, and that's to figure out what something's worth and try to buy it for less. Distressed debt investing is not different in that regard. We have to do the same thing. You look at a company, you look at the business, you figure out what it could make in a normal environment, you figure out what that company would be worth, generally thinking to a buyer, to a strategic buyer, once its problems are largely resolved and once the capitalization has been restructured. Then you think about how that value will be divided up among the various classes of claimants, and you figure out what a piece of a claim is worth, and you see if you can buy it for less. And if you can make those judgments on the basis of conservative assumptions and still end up with good room for profit, then that's a source of margin for error. I mean, I think that the margin for error comes primarily from being able to use conservative assumptions and then still be looking at a generous rate of return, you know? Now, it's very, but before I stop, I must say that it's not true that the more conservative, the better, because you can get to the point where you can make assumptions that are so conservative that you'll never lose money, but it will give you a target buying price which is so low that you'll never buy anything. So you have to kind of gut it out and be willing to include some optimism, or else you may never get to buy anything. Now you mentioned catching falling knives, and my vision is that when the stuff hits the fan and there's blood in the streets, most people go like this, and they say, well, we're not going to buy until the knife stops falling, until the dust settles, until all the uncertainty has been resolved. But the trouble is that once that happens, then the price will have rebounded. So we want to buy at a time of upset, and while the knife is still falling. And I think I think that the refusal to catch a falling knife is a rationalization for inaction. It's our job to catch falling knives. That's how you get bargains, but you have to do it carefully.